What is margin call? A margin call happens when the value of your investment in a margin account falls below the minimum required amount by your broker, due to losses. The broker asks you to add more money or sell some investments to bring the account back up to the required level. To understand margin call concept, first of all we need to understand what is margin trading and how does it work. So now we look into what is margin trading. Margin trading is a method of buying or selling financial instruments, such as stocks, cryptocurrencies, derivatives, or forex, using borrowed funds from a broker. Instead of paying the full purchase amount, you only invest a portion of it, known as the margin, while the broker lends you the remaining amount. The margin acts as collateral for the borrowed funds and is typically a percentage of the total trade value. This type of trading amplifies both potential gains and potential losses. Total investment equals margin plus borrowed money from broker. Now we look into how does it work. You need to understand that the broker lends you funds to increase your buying power. This gives your financial leverage to you. For example, if you have 10,000 rupees and the broker offers 5:1 leverage, that means you can trade up to 50,000 rupees. Now we use formulae of leverage as leverage equals total investment divided by margin, or debt, that is borrowed money, divided by equity. Equity is nothing but your own money. In margin trading, brokers set specific conditions to protect themselves from financial risks and ensure traders comply with regulations. Among few conditions, two of them are important. First one is initial margin requirement. This is the minimum amount of your own money as a percentage of the total trade value that you must deposit to open a leveraged position. For example, imagine that the broker allowed us to start with 10,000 rupees to control 60,000 rupees worth of stock. So, our initial margin requirement was 10,000 rupees, which is about 16.7% of the total position. The second condition that the broker is going to set is the maintenance margin, also known as the minimum margin. It is the minimum equity you must maintain in your margin account. If your account falls below this level due to market losses, a margin call is triggered. To understand it in a better way, consider an example with 10% maintenance margin. Let's assume you want to buy stocks worth 60,000 rupees. But you only have 10,000 rupees. Imagine your broker gives you 50,000 rupees by keeping your 10,000 rupees investment or equity as collateral. And your broker says, keep at least 10% of the total investment value in your account. That's 6,000 rupees. Let's suppose the next day, your investment falls to 56,000 rupees, then your equity becomes like below. Equity is equal to 56,000 rupees minus 50,000 rupees, which equals 6,000 rupees. Which is the same as the maintenance margin. You are just safe. Now, assume the bearish trend continues, and the value of your investment drops to 55,000 rupees. Then your equity becomes 55,000 rupees minus 50,000 rupees, which equals to 5,000 rupees. Since this is less than the maintenance margin requirement of 6,000 rupees, you would receive a margin call.